Hey, what's going on, guys? Today we're going to discuss moving average basics, and this is designed to get you up to speed and understand what they are. So very simply, a moving average is a price analysis indicator which smooths out price data by creating a line on a chart. Now, these moving averages can be used anything from stocks, index funds, fiat currencies, and also cryptocurrencies. Now, there's two main types of moving averages that are used are EMAs, which are exponential moving averages. Those are the ones that I use 99% of the time. And then there are simple moving averages, or also just known as a moving average. Now, the main difference between the two is that the exponential moving average takes the most recent price data and it factors it in to the equation a little more. The EMA can be argued that it's better for traders because the most recent price action is being reflected a little bit better than the simple moving average. So the simple moving average just takes every day and divides it up equally. The exponential moving average means that it's still averaging out those days, but the most recent price action has more effect on the moving average. So you can look that up on investopedia.com and figure out what the exact formula is. But I tend to use exponential moving averages the most. There's no wrong way to go with that. It's really just a matter of preference. Now, for me, when I'm trading, I'm heavily focusing in on the 8 and the 21 and also the 55. Those moving averages are the ones that fluctuate the most because they take into account the most recent price action. So when you look at this chart, and this is a chart of the S&P 500, this goes back to May 2020. We can go further, but just for example here, you can see that the candlesticks have been above the 200-day moving average, the 100-day moving average for the majority of this period. It was actually below it over here. And that's because we were coming out of the Corona crash or correction, however you want to describe it. But this was the Corona crash. So we fell below all the moving averages and we went lower. Then the market started to recover and it started to reclaim those moving averages. So ever since the market reclaimed the 200 and the 100-day moving average, it has not looked back. We're still well above the 200, we're still well above the 100 and the 55. Now, there were dips here which came back to test those moving averages, and you can see the market bounced pretty aggressively after it touched those levels. So one can assume that these areas have strong price support, which means that buyers stepped in heavy in these areas and we continue to ride the market higher. The moving average really just gives you a very, very simple view of any market that you're looking at. Is it going up? Is it going down? S&P 500 is going up. We're above all the moving averages. We're also above the 8 EMA, and that indicates a strong trend. Now, there's many ways to use this, and I use these indicators when I'm trading intraday. So this is a daily chart. So every candlestick you see here represents 1 day of price action. But what if we go to an hourly chart? Now it's going to look a lot crazier because within an hour, it could do a lot. Within an hour, we could drop below the 200, we could go back up, we can go back down. So a lot can happen on an hourly time frame, right? So when I'm trading, I'm looking at all of this data. I'm looking at the hourly, I'm looking at 4-hour chart, I'm looking at the daily chart like we were just looking at. So all of these moving averages can be used on multiple time frames. So you can use it on a daily chart, a 15-minute, a 5-minute, a 2-minute, an hourly, a 4-hour, it doesn't matter. And that's the wonderful thing about them because these average prices take into consideration the time frame that you're looking at. So if you go to 15 minutes, these moving averages are going to reflect that accordingly. So you can see here on the 15-minute, we broke below all the moving averages at one point, and then we popped back above it. But if you look at the daily chart, you wouldn't really know that happened in this area because on the daily chart, the trend is still higher. But on the hourly chart, you could see ups and downs and all that stuff. So these moving averages show you the momentum behind price. And so when you're trading or investing, you want to know where your moving averages are. If you're looking at, let's say, the S&P 500 and you want to invest, then you're doing a good job because this market is going higher. Now, if you look at other stocks, let's say like a Plug Power, for example, right now, as soon as we started to break below the short-term indicators, the 8 EMA, the 21 EMA, price started to drop pretty quickly. For example, this stock, plug is not the best looking chart because we're below all the moving averages. We're just starting to try to get above the 8 EMA again. So if it gets above this and then it gets above these lines here, then it could start to trend higher. For now, the trend overall is still down because we are below the moving averages. So that's an opposite example. So you can have a stock like plug going down when the stock market itself and the index and the bigger companies are still going higher. So this is a quick intro to moving average basics. I'm not going to go into all the little nuances about it in this video, but you can add this indicator on any platform that you're using. So if you're using TradingView.com, you can just type in exponential and then you'll see there moving average exponential. If you want just a regular moving average, you can just type in moving average and you'll see it there as well. So this can be used on any platform. You can also use it on something like stockcharts.com. So that's it. There's also a PDF document that can serve as a study guide in addition to this video to give you a little more context as to how to use these moving averages.